The Trade Desk and Roku are interesting businesses to compare as they compete in the connected TV market and now in the TV operating system market as the Trade Desk is making an entry into that space. I'm going to compare these two companies on revenue growth, on operating profit margin, on cash flow, and on the returns on invested capital, and then compare them on their valuations to determine which one of these two growth stock is the better buy for long-term investors today. Let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking back 5 years comparing these two on revenue growth, we see that the Trade Desk has generated better revenue growth than Roku in most quarters going back 5 years, and then especially over the last 3 years. Although Roku is making a great effort accelerating revenue growth since bottoming in 2023, especially now that Roku is manufacturing and selling televisions, that can be a nice boost for revenue, although Roku will need to increase the capital investment because of the shift into a more capital intensive industry. Meanwhile, the Trade Desk is also entering a new industry, one that Roku dominates, the TV operating system. This is more of a software investment. This is more capital light than Roku's investment into TV manufacturing. And if successful, these two entries into new categories for both Trade Desk and Roku could yield significant revenue growth improvements for these companies over the next few years, on top of the already attractive industries that they're operating in, where they're already generating north of 20% revenue growth. The next metric I wanted to compare these two on is the operating profit margin over a trailing 12-month period. In the last 2 years, they've both done an excellent job reversing the downtrend in their operating margins. Roku, more recently than Trade Desk, has improved their operating margins, but they're still negative at 5.3%. Trade Desk has also improved its margins, but they're positive at 17.5%. Roku entering into the manufacturing and selling of TVs, its profit margins could take a near-term hit as it ramps up the manufacturing and scale of this business, but it's already going very well. It's signed on some very large partners in Walmart and Amazon as sellers of their TVs, and given their success with the operating system, remember Roku has the #1 operating system in the United States, Canada, and Mexico. It seems like people really like Roku's TV operating system. So that makes it more likely that they will purchase a Roku TV because they're already accustomed to having Roku TVs. Now they're going to be manufactured by Roku's as well. I don't think the consumer public understands that Roku, the operating system that came with some Roku TVs, but they were not they were not manufactured by Roku. I don't think people made that distinction. I think people have a greater connection with the operating system than they do with the manufacturer of the TV. And so they've already given Roku a good rating in terms of brand loyalty. The Trade Desk, therefore, has a difficult going in trying to take market share from Roku in the TV operating system. The good news is that the market overall is growing so rapidly that could leave room for the Trade Desk to take some market share without taking it away from Roku, because the connected TV market is gaining in comparison to people who used to uh, watch more TV from legacy TV providers like DirecTV and cable television providers. And so connected TV is gaining market share at the expense of those legacy providers. The cash flow from operations, a similar story, although it's even more in favor of the Trade Desk at 30%. And this has been rising over the last several years as well. Roku's done a good job in this metric as well. Roku's cash flow from operations, early days may be difficult with the manufacturing, although again, they are off to a good start and they are increasing this more measured. They're not going all out in the production of these TVs. And so it might not be too big of a deal in terms of the hit to cash flow that inventories could place on companies. But I suspect that the trade desk will generate better cash flow from operations than Roku for the foreseeable future. Returns on invested capital is another category that the trade desk beats Roku at 16% compared to negative 5.38%. So far, in nearly every category we evaluated, the trade desk was performing better than Roku regards to operating margins, cash flow, and returns on invested capital. Whereas revenue growth, I would say, was more of a tie, and then the trade desk wins on the other three categories. And surprisingly, when measuring these two on valuation on the price to free cash flow, the trade desk is selling at a cheaper valuation at 53 compared to Roku at 58. Given that the trade desk exceeded Roku in many of the key categories, I would have assumed that Roku would trade at a discount to the trade desk. Instead, it's the flip side. The trade desk is trading at a discount to Roku, and it could have to do with the big drop off in trade desk's valuation. It's down nearly 50% already year to date in 2025, which has made its valuation a lot more attractive in comparison to Roku when measuring by the price to free cash flow multiple. When measuring by my intrinsic value per share, Roku stock, I have my intrinsic value per share calculated at $86. The current market price is $85. So Roku stock looks fairly valued according to that metric. The Trade Desk stock, my intrinsic value per share calculation came in at $55. The current market price is $66. So it's within my margin of safety for giving the company the category of being fairly valued, although the valuation compared to the current market price with the intrinsic value comparison is more in favor to Roku. But I would expect that the Trade Desk would be trading at a more premium valuation given its better metrics. So, to answer the question, which one I think is a better stock to buy? Now, I like both of them. I have both of them rated as a buy, but if I had to pick only one of these two excellent growth stocks, I would pick the Trade Desk as the better buy at current prices.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.